Director at JP Morgan Treasury Services in London. He has worked in the financial services industry for many, many years. I think you're a born and bred Scot though, Steve. That's true, but he has been in London since 1980, I think, and that makes you half an Englishman, or don't you get something like that? But I think he's been intimately involved in banking as such, from operational side, credit perspective, payments perspective. He's consulted on payments through a couple of larger names that you'll recognize: KPMG, Atos, CMG. He joined JP Morgan in 2006, and in that role, he's been involved in product development, and then also represent JP Morgan as the shareholder on the European Banking Association. And I think a person that is well positioned to talk to us about what is happening in the payments dispensation that they have there, SEPA, and what is coming, what's the implications of certain things. I think a couple of announcements was done quite recently, last 3 weeks or so, I think, Stephen, around the payments directive, or what do they call it, PSD2, that's correct. And I think the impact of that is phenomenal, and we have to understand that. So without further ado, Stephen, it's really a privilege to have you here. Welcome in South Africa, and we look forward to what you have to say. Thank you.
Okay, testing now? Good, okay. Thank you for the introduction, and thank you to PASA for giving me the opportunity to come to Johannesburg and give you some background on SEPA, and also thank you for organising a very British weather and climate. Makes me feel at home. So, as was indicated, I've been working in SEPA since 2006. I'm actually going to take you back further than that to 1999 to start the journey, when I'll take you through how Europe has changed and how SEPA has really changed the payments landscape and really benefited all the users in Europe. We'll go through the history and how we got to where we've got to and the successful migration that we've now seen, but that further harmonization and challenges await us, and indeed further industry challenges await us through the likes of the PSD2. So going back to 1999, it was started with the single currency agreement when the core European countries opted to and launched the single European currency, the euro, because prior to that we'd had legacy currencies, and it made it very difficult for any cross-border trade. So the first advent was that we had the single currency, as I say, the euro, which allowed the exchange rates to go away and allowed consistency of transactions between countries. But it did not enable payments to go easily between countries. We had the changed national ACH payment systems, which became and allowed to be transacted in euros, but there was no ability to do a cross-border transaction without it just going through the standard SWIFT and correspondent banking network. So there was a need to change that, and we'll come on to that in a second. But what the market really wanted to do was do more than just make it work. They wanted to make it actually future-proof and use the standards of ISO 20022 to make sure that every user could see all the details as they process through the system. So consistent standards. If you did that, it was going to allow our corporates to look at all their accounts throughout Europe and gain benefits from being streamlined and not having to multiple bank throughout all the countries in Europe. It was going to allow lower processing costs because there would be less bank accounts, there would be more consistent transactions, and one of the core benefits of SEPA was to remove the difference in pricing between a domestic and a cross-border transaction. SEPA made it absolutely certain that you could not charge more for a transaction going from France to Germany as just domestic transactions in these countries. That's going to prove more benefits also to the corporate community because of working capital improvements, a much better consistency of management of cash, rather than worrying about where is all my different accounts and where is all the transactions and the relative balances sitting. But that's not to say that it was going to cause, it's going to be an easy migration, and we'll come on and talk about that as we move forward, is that actually this was quite a tricky process for all the market players. For a corporate, they were used to dealing with individual banks, individual formats, and legacy formats, so they had to move and change to working with probably the same banks, or maybe one bank if they were really ambitious, and move to using ISO or some form of conversion service. And as we all know, that's quite a significant challenge for corporates, as they needed to have a good project, they needed to have the ERP systems that could adapt and change legacy account numbers, legacy structures into this international standard. And I think this has proven to be one of the thorny issues of migration, is just getting the corporate community to get to the stage of using the more ISO message format rather than what was coming out of the ERP systems previously. For consumers, this was going to be great benefit because they can now send transactions again from one country to another without paying inordinate fees. And we've seen more and more, interestingly enough, more and more fintechs come into that space and really driving the consumer use and ability to send transactions across borders at a much more reasonable costs. But of course, one of the challenges for a consumer is they've been very used to the domestic behavior of what we call the BBAN, the bank account number. Because to make a SEPA payment work, we introduced the international bank account as being mandatory in the transaction process between parties. And that is taking quite some time for the consumers to get used to using an IBAN, which is not an easy number to remember, of course, but it is now becoming more and more prevalent in the space that consumers really understand that. And of course, the market benefit was in principle that they would be able to reduce the amount of core systems that process low-value transactions, and it was going to be, in theory, cheaper and quicker to process payments. And that has proven to be the case, but as we will see a bit later on, not all ACHs in these countries decided to allow it to move to a central environment. So why did the market decide to do this? Well, it was actually driven through the ECB decided to, or the European Central Bank decided they wanted to make sure that the euro in 1999 wasn't just left to train its own. They wanted to guide the usage and guide corporates to and consumers to use SEPA, and really wanted the migration from domestic schemes to move to this as quickly as possible. The cross-border regulation was created to encourage this. It was repealed in 2009 to further underline the need to become SEPA compliant. But what we're going to find out as we move forward is that the timeline took a lot longer than was originally envisaged. So if we started with 1999, we started with the cross-border regulation, the idea to encourage the market to take this forward. As part of this, the European Payments Council was formed in 2002 as a collective body to encourage and define the schemes and define the usage of the ISO 2002 message set, to encourage and define the rules that all the banks had to adhere to. What was actually quite interesting on that is that the ISO 20022 scheme that's used is not the full message set. So we have a particular scheme that's chosen, and they have what's known as white fields and yellow fields. Yellow fields being the fields that are used within the processing of a SEPA transaction. That leaves a lot of the fields actually unused. And so it's not really a full set of ISO tags that are used in the SEPA transaction space. By 2002-03, we had the start of Euro notes, and that made it suddenly you could actually see euros in action, and that started really corporates starting to think about how do they move to really put this project into reality. The initial countries that had started having euro as their currency, which was France, Germany, Italy, Spain, Belgium, Netherlands, Luxembourg, Ireland, Portugal, Austria, and Finland were joined as Greece joined the euro in 2001. And you will see as the timeline goes on, more and more European countries opted to join the euro as their core currency because they could see the benefits of moving away from their legacy currency and using and becoming part of the European economic growth. So we had Slovenia joining in 2007, Cyprus and Malta in 2008, Slovakia in 2009, Estonia 2011, and other Baltic states of Lithuania and Latvia joined in 2015-2016. So SEPA has seen a continual growth of the ability for more and more countries as they join the euro to allow transactions to go across these borders, as I say, at the same standard, the same price, and allows a much easier way of paying suppliers, vendors, and consumers. In terms of the payments infrastructure, though, as I said at the start, it was for euros. The start was just correspondent banking, and the expense and problems that are adhered to that. Therefore, we produced the RTGSs linked together and formed Target 2, and that was the first real ability to have one core system. And that Target 2 is now the RTGS for settling of euro transactions across the European community. Indeed, works as a settlement engine for all low-value transactions that are processed through the SEPA CSMs. The first pan-European cross-border low-value clearing was actually a clearing launched by the EBA called the XCT. And that was launched in 2003 and allowed cross-border low-value transactions to go between these countries in adherence with the cross-border regulation 2001. But you'll note from here, if you can read the writing, that actually that payment system closed in 2011. So it was actually only around for 8 years, which is quite a short lifespan for a payment system. And the key reason for that was because the PSD, the Payment Services Directive, or PSD1 as it's now known, was launched in 2009. And unfortunately, the XCT system was non-PSD compliant. So therefore, it only had a short lifespan, and there was no need for it to expand because the advent of the core SEPA clearings came along. And as we see, 2008 saw the start of the SEPA credit transfer, and 2009, the SEPA direct debit. And these were the schemes that were defined by the EPC to allow transactions to flow, as I say, domestically and cross-border within the SEPA region. It may be worth just whilst I've rattled through all the countries that are members of the EU and members of have euro as the currency, which is the first group in the first box there. SEPA wasn't just about the countries, or isn't just about the countries who have euro as their own core currency. Because of a number of countries that trade and do a lot of business with the SEPA countries, a number of these have also signed the adherence agreements and signed as part of the European Union that they participate in SEPA. So you see the second group of countries, Bulgaria, Croatia, Czech Republic, Denmark, Hungary, Poland, Romania, Sweden, and the UK, all members of the European Union today. I don't know what will happen in a couple of years for those of you who have understood what's going to happen with Brexit. But for now, all these countries, part of the European Union, can all offer, or all the banking providers can offer SEPA credits and SEPA direct debits to connect domestically, but probably more likely to be cross-border. So all these transactions that they want to emanate between these countries and all the countries on the left will be used and be SEPA compliant, operating under the same conditions. So you're not allowed to take any charges if you're sending a SEPA transaction from, say, Denmark to Estonia. Further country reach comes with what's known as the European Economic Area, which is Iceland, Liechtenstein, and Norway, who also are, as countries, part of the European Economic Area, obviously do a lot of trading with Europe, and they want to also enable the ability to send SEPA transactions to and from all the other countries. SEPA doesn't stop there. There are other countries which are not members of either the Eurozone or the European Union or the European Economic Area, but have decided to sign the necessary adherence agreements so that they can participate in SEPA. And these are these ones are Switzerland, Monaco, San Marino, and now very recently, just in May, the Crown dependencies which are associated with the UK, which is Jersey, Guernsey, Isle of Man. And indeed, this doesn't stop because Andorra, that small republic, will be joining in later, probably about October, as they want to ensure that they can use SEPA as well. So, as you can see, that's quite an extensive reach and continual growth. And indeed, we know that there are a number of other countries that are keen to join, well, either the European Union or just join SEPA as well. So we'll see a continual growth of this as the success of the scheme and the success of the euro continues. I talked about, well, we talked about earlier about how would clients move away from the domestic schemes into SEPA, and there's quite an elongated migration project. And initially, it was reliant on corporates and consumers seeing the business case. It was reliant on banks communicating to their users that moving to SEPA would be a good idea, and could you please do it by 2010? Well, as I'm sure you're all aware, just encouraging clients to do that, you will easily do that, and it did happen for those clients who could see an immediate benefit, particularly those who were involved in pan-European business, multinational corporates could see the use on simplifying. But really, a good many of the users didn't immediately get the business case, so therefore the migration figures proved to be less than what was expected. And 2010 became unrealistic. So what had to happen is they had to introduce regulation. So it had to drive the use of SEPA, and it had to come as a mandatory exercise and a mandatory need to do that. So the SEPA regulation 2012 was created to ensure that all players moved to SEPA and that the legacy schemes had to close down. And the new target was 2014, February 2014, to encourage and ensure that all the banks and the providers were able to move to become fully SEPA compliant and in theory close down the legacy clearing systems. The reason we've got 2016 on the end timeline or line there is really around the fact that for the non-Euro countries there was an extended timeline to allow them to adhere fully to SEPA. The other aspect, though, is one thing putting in the regulation, because that really shot the banks up to really think, how do we make sure all our consumers and corporates adhere to this and migrate? But of course, the corporate community and the consumers all need to understand, well, what do I need to do? I don't really understand what this SEPA piece is. So what was quite good and what we saw as quite effective was a lot of industry collaboration in the producing of things like user guides or best practice guides in terms of anything from direct debit returns or the way transactions operate across the community. And we certainly saw a lot of customers really benefiting from understanding that, because they were so used to operating in their individual country units that it was quite difficult for them to really understand, well, hold on, I've got a return from Germany which looks completely different to a return from France. And what should I be doing to sort of understand that? So user guides worked very well because it meant that we got user expertise from across the European countries and produced a guide that was produced by the users, not just by an individual bank. And that was seen as a very good way of being collaborative and ensuring a very consistent way of clients understanding how SEPA works. And talking of the ACH harmonization, just for a minute, as I explained, each individual European country had its own ACH or CSM for processing its domestic transactions. Each one of them had to decide whether to make it SEPA compliant or whether they decided to use the only pan-European one, which is the EBA's Step 2 solution. Excuse me. What we've found is a number of countries opted to develop. So we had France, Spain, Portugal, a number of other countries decided to spend the money and make their domestic scheme SEPA compliant. And by and large, they were focused very much at the domestic use, because obviously 80–90% of the transactions were still going to be domestic in nature, from a French corporate to French consumer, et cetera, et cetera. But a number of countries decided not to spend that money and decided to just use the EBA Step 2, with one anomaly. Belgium decided to use as a French CSM because of their association, I guess. But it just gives an idea of that some countries opted to use a centralized system and others decided to still have the protection of their own domestic system, which still had to be SEPA compliant and still had to connect to the pan-European system, but allowed them a bit of flexibility in introducing more and more clearing cycles within SEPA, for example. It's maybe actually just something I'll touch on. One of the big advantages we've seen from SEPA is the speed of clearing of each transaction. So what we have in SEPA is we have 5 clearing cycles per day. We have an overnight cycle, so that's transactions typically batch orientated that come from corporates, maybe payroll, which are cleared and received by the beneficiaries first thing the next morning. And then you have 4 intraday cycles, which allow for transactions to go, as I say, and cleared intraday, albeit that the beneficiary may not receive the money until a bit later in the day. But we're seeing more and more activity as corporates realize just how quickly they can send transactions and use SEPA rather than perhaps the more expensive wire systems. So SEPA continues to mature. We've got a number of things we still need to do to iron out some of the behavioral characteristics. So for example, I did say that we produce these return guides, but we're finding that by doing so, we've created as many questions as answers, and we're still maturing that a little bit more to give corporates further guidance so that they can, although they start to benefit from closing down legacy accounts that they don't need and gain that benefit, they need to be very clear about their cross-border processing. So they were used to domestic, they centralize, they get benefits from operating payment factories, but if you're having a treasury center payment factory operating all your European transactions, you obviously need to have the local expertise to understand, still, I get a return that's coming from Germany, Spain, France, etc. I really need to understand what that means to my back-end processing, because the last thing that we find they want is something that falls on the floor. They want there to be an automated process as that transaction returns. It's one thing maybe worth just mentioning is that foreign exchange aspects to SEPA processing is out of scope for the regulation. And although some banks do offer this, i.e. the ability to send, let's say for our bank, it would be the sending of maybe a pension file, debiting a US dollar account and sending euro transactions through SEPA and really getting the benefits of, say, a pension file. Or it could be another bank in Germany whose customer only has a different currency account and wants to receive a SEPA transaction and then put the FX, make the FX happen upon receipt and credit the client's account. The FX component is fine, but is outside the scope and the remit of the regulation. We mentioned the PSD1 is one of the key drivers to enable all these countries to adhere to standardized processing in SEPA. We now have coming in a couple of years is the PSD2. So although this enhances some of, and makes it a bit clearer in terms of the number of currencies that the PSD2 encompasses within the European area, and also allows a bit more clarity on every transaction that has come from outside Europe that's been processed within Europe, the PSD2 makes it clear that all transactions within the one leg that's in Europe has to be compliant with the PSD. But what's interesting is what the PSD2 is going to do for third-party payment processors, access to payment systems, and access to account information. Because it's making it regulatory for all banks and providers to make their accounts and their payment systems available to these third-party new players on the block, and really opening up gateways for fintechs to be very innovative and allow to develop services. And it's going to take up a lot of time, I think, in the market as we look at what the impact of that is going to be. So for example, today, a multinational corporate will bank with several banks and will probably have individual tokens that they have to use to make payments, individual tokens to see all their balances from all their different banking providers. Excuse me. But what this regulation is going to allow to happen is that a bank may provide a holistic account reporting service, or indeed a third-party service provider may do that. So an accounting firm or just somebody new in the market can actually go and obtain balances throughout any bank in Europe and provide additional services, reporting services, reconciliation services of all that account information that is available. So that's fundamentally going to achieve an opportunity to be more efficient, but also create some challenges. As you can imagine, that it's very interesting that the PSD2 says that it's going to enable this, but the infrastructure must have what's known as SCA, or strong customer authentication. But how are you going to police that? How are you going to enable it is probably one of the biggest questions that all us bankers have, in terms of suddenly all these third-party payment processors are going to start processing transactions against our accounts. I mean, I think my bank is primarily a corporate bank, but from a retail consumer banking perspective, that's going to be quite a substantial challenge. How are you going to make sure you know who is transacting against your account? And so some of the definitions have still to be made and are due out in the next month or two in terms of, how does the banking market allow and make sure that the SEPA transaction or the payment transaction is from your customer. Other market developments are coming. We are seeing further maturing use of the ISO, and I can see some of the panel sessions today have talked about ISO as well. As we see ISO being rolled out globally, we're now seeing users actually using ISO properly. I think it's fair to say that for SEPA, it was a lot about plug and play. We'll take our domestic format and somehow we'll manipulate it into ISO 20022, but I haven't really thought about how I use ISO properly. We're now having discussions with corporates as they realize that their ERP system providers can actually support SEPA properly. And by that, I mean populate all the fields, all the reference texts, they're all structured reference, allow better reconciliation, and allow to provide more information to their beneficiary as well, and make everyone benefit. But the other interesting market development that's coming is instant payments in Europe. So this is scheduled for the end of 2017, beginning of 2018. And this is where it's going to be possible for a consumer in one country to send a payment to a consumer or a merchant in another country within 10 to 20 seconds, and throughout the whole pan-European region. That's, we believe, is fundamentally, well, it's a big challenge, but it's also going to really change a lot of the payment markets. And what was quite interesting, actually, was there was a lot of talk, I think, at the plenary session around that a lot of these new innovators still use the standard payment rails. I think we all see that instant payments will be the standard payment rail, and the innovation will come more from the use of the fact that you can now transact between two parties within seconds. It's what does that information do, and what does that enable from an e-commerce perspective, or even from walking into a shop with your iPhone. Will instant payments allow you to make that transaction instantaneously from your bank account rather than from your card account, etc. So a lot of work still to happen on instant payments, but it's definitely one of the most exciting areas that we will see happening within Europe. But of course, it's not just about Europe. Instant payments we're seeing around the world, and certainly, my bank's involved in aspects in the US. UK's already live. Australia's going live. There is so many of these schemes, and I've only touched on the countries. Instant payments will work with third-party payment processors within the PSD2, and we will see a lot of change to the European payment landscape as we go forward. So, as a summary, I would say that it's been a long journey in migrating SEPA. I think the ambitions of moving within the 2010 timeline were completely unrealistic. I think the market quickly realized that. But I think the lessons that we perhaps should have thought about at the start of SEPA was being clear with the definition, because clear documentation makes it much easier for all the parties to understand how to process SEPA transactions. There needs to be a clear process for debating concerns and understanding of how you put this market together, and a collective, collaborative body is essential. And that brings me on to collaboration. It was one of the things that my team certainly valued was the ability to go to other parties and other banks and have an open dialogue about how we should make SEPA work, or how does SEPA work in Estonia or Spain or France. Because although we have branches in 9 European countries, you saw from the list there's a lot more than that. And so it was great for me to be able to go to another bank in another country and say, just how is the direct debit being processed, in your country? So, and putting that framework together and that sharing of best practice to make SEPA work was definitely one of the best recommendations you would look at as you try to devise something like that. So you're not looking there at the competitive space, you're looking at the collaborative space to make the end-to-end payment work between the banks involved in the transaction. The EBA has business working groups, so the EBA Step 2, which allowed community sharing of and understanding and opinions to be made. So that has helped develop SEPA alongside what the banks and the user community wants, not just here's some ideas that we've thought of. And that's also obviously been seen at the national community level as well, as these CSMs or the ACHs in each of the countries have devised their own SEPA services. We've seen a lot of community sharing of knowledge has benefited that dialogue. I've already touched on this, but the biggest driver, of course, was regulation. If we hadn't had regulation to make this happen, I think we'd still be here at about a 50% migration rate. Because there just wasn't enough business case for certain of these organizations to really push, and it definitely needed regulation to make this work. Once that was put in place, guess what? It worked. Well, there was a 6-month extension in 2014 to finish it off, but we now have all the electronic payments processed within these European countries, with a few domestic exceptions, processed through a SEPA scheme. It's just worth touching on these exceptions. There are 1 or 2 exceptions in different European countries where they deemed that the legacy transaction type, which was unique, was some form of letter of credit perhaps, or a tax payment, that the local country was able to define as a domestic transaction type rather than it being able to migrate to SEPA. So we still have some of these anomalies, but I would say a very high 90s percentage of electronic transactions are now SEPA compliant within that country set. And I'd say some of the key benefits, just as a reminder, is we've got standard processing, standard usage of message sets, so that a client can, in theory, move from one bank to another and expect the same level of service. The transactions between France will operate in the same manner as between France and any other country within the SEPA zone. Hopefully that gives you a potted history of what we've seen happen in SEPA in terms of where we've got to, the success it's been, some of the lessons we've learned, and I'd be happy to take any questions.
Okay. I think the one question that's probably on many people's mind here is PSD2. You get the sense that the European Parliament, through announcing that, and one speculates about regulators generally, they are leveling the playing fields with regards to fintechs, and one get a sense that banks are being marginalized a little bit, almost to be utilities going forward. Now, with your JP Morgan hat on instead of your SEPA hat, how do you play, in a space where those things seems to be a trend that the regulators start to introduce?
Yeah, it's a very good question, and it's the right question, because I think if you look at it straightforward manner, you would see, and I say with the instant payments, you would see the bank is getting pressed into processing the commodity element of a transaction. So it would be just the settling of transactions, where there's very strict regulation around who's allowed to have a bank account, who's allowed to settle a bank transaction. And you see a lot of that being difficult for the new entrants. The new entrants are concentrating at the perimeters and the outside. But I think my response to that would be, each bank needs to think, well, hold on, I can still process payments and be the commodity element. I can service and be collaborative with these new fintechs. Or, dare I say it, I can become a fintech myself. not necessarily a fintech in its innovative sense, but providing account information services, for example. So why shouldn't a bank start to think, well, I'll pull information from another bank and provide an account-level PSD compliant service without the need for a new startup to be providing that. So I think there's opportunities. There's opportunities to work with fintechs, but obviously fintechs will also provide some challenges from their own right. So interesting times ahead.
Absolutely interesting. Let's hear, is there some other questions in the audience for Steve? There at the back, Walter.
Can you just give some more clarity about PSD2? What the access to information really means? Can they, for example, initiate a payment by virtue of the access that a bank gives them through the API? Or is it just information? So they can see it, but they can't initiate an actual movement of funds. So
Sure.
just help
No,
me with that.
the answer to that is it's both. You can be an account information service provider, or you can be a payment initiation service provider, or both. Obviously, there is, on the payment side, there is perhaps a different set of who might be providing that. It's more the third-party payment processors who are looking to work with merchants in terms of making it easier to debit a number of banks within the same method, whereas account information is more about collecting the information and reporting it in a singular format. But yes, it's about both.
Thanks. Building on what Walter's just asked, this way.
Oh, I'm sorry.
Building on Walter's question, the personal account directive is also coming down the track.
Right.
In terms of what information is shared and so on. Can you give us some more insights into that?
I'm not an expert in the PAD, Payments Account Directive, essentially because that is primarily focused at consumer banks. We're unfortunately a corporate bank. But some of the things we're having to think about is, as they look at one of the most common things is the definition of the improvement of account switching. So as to enable consumers to move from one bank account to another, one bank to another, they're introducing all sorts of levels of service that are expected for somebody to move one account to another. As a corporate bank, we're not covered by that, but we have to tell our customers that your consumer has moved from one account to another. So there's a lot of question marks about how that's all panning out.
And that could be something to look at for the authenticated collections around customers moving banks and the banks themselves having to hold that authenticated mandate of the client.
Yes, I think there's different models that will happen. So I think there's a different model in the Netherlands, for example, than there is the rest of Europe where it will be centralized, but the Netherlands have very centralized focus on some of this.